Hi everyone, in this video we'll be going over A-Level Accounting 2023 May-June Paper 2 question number 1. So this is the structure paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit given for this paper is 1 hour and 45 minutes. And since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 35 minutes. So without any further delay, let's get started. GA Limited's financial year ended on 30 September 2022 and the following balances were available on this date. Okay, we're given a bunch of information. Let's move towards additional information. So we're given inventory at 30 September 2022. So this is basically our closing inventory and it was valued at 57,000. The balance of the account of a credit customer, 3,000, should be written off as irrecoverable debts and charged to administrative expenses. So let's just add this amount of 3,000 to our administrative expenses. It's given right here. So that's going to be plus 3,000. Alright. Then the directors have agreed to create an allowance for irrecoverable debts of 5% of trade receivables, and the allowance should be charged to administrative expenses. So let's figure out the allowance for irrecoverable debts closing balance. Remember, while calculating allowance for irrecoverable debts, we also have to adjust for our bad debts. So we know that we're given trade receivables as 83,000, but before applying the rate for allowance for irrecoverable debts, we first need to subtract the bad debt of 3,000 and then multiply this amount by the rate of 5%. And this results in the closing balance for allowance for irrecoverable debts to be 4,000. Now the next step would be to compare this closing balance to the opening balance for this allowance. Let's have a look above. So we're actually not given any allowance for irrecoverable debts at opening date, so we just assume it to be 0. So if we compare our opening balance of 0 to that of the closing balance of 4,000, we can clearly see that there is an increment in our allowance for irrecoverable debts, and this increment, we're told here that the allowance should be charged to administrative expenses. So we're just going to charge this 4,000 as well to the administrative expenses. So that will be plus 4,000. Alright. Then debenture interest for the second half of the year is outstanding. Let's have a look at our debenture. It's 8%, so that's the rate, and the total amount for debenture is 100,000. So the interest on debenture is just going to be the amount of debenture, that's 100,000, multiplied by the rate, that's 8%, which results in 8,000. And the information we were given is that debenture interest for second half of the year is outstanding. So half of this amount will belong to the first half of the year, which is 4,000, and this is already paid. But the remaining 4,000 is still yet to be paid. So this will be our outstanding expenses. And the finance cost is given right here, which includes 4,000. And this 4,000 is just going to be the interest for the first half of this year, which is already paid. But if we're trying to prepare the statement of profit or loss, we need to charge the entire interest on debenture as our finance costs. Alright, then we're given that the non-current assets should be depreciated at 20% per annum using the straight line method. Let's figure out the depreciation. That's straight line method, so we can just charge this rate to our cost. And the cost of non-current assets is given to be 1,300,000. So that's 1,300,000 multiplied by the rate of 20%, which results in the value of 260,000. And the depreciation should be allocated as follows. For administrative expenses, 60% of this value should be allocated. So that is just going to be 260,000 times 60%, which results in 156,000. So let's add this to administrative expenses. That's plus 156,000. And for distribution cost, that will be 260,000 multiplied by 40%. This results in the value of 104,000. And let's add it to distribution costs. It is given right here. Since we're done with all of the additional information, let's figure out the total for administrative expenses and distribution costs. For administrative expenses, that will be 28,000 plus 3,000 plus 4,000 plus 156,000, which results in 191,000. And for distribution cost, that is just going to be 57,000 plus 104,000, which results in 161,000. Okay. Now for the first part, we need to prepare the statement of profit or loss for the year ended 30 September 2022. Okay, let's start with our revenue. We're given revenue right here, and that's 869,000. Since we're not given an additional column to calculate our cost of sales, we can just calculate the total of cost of sales and write that value down. Okay, so we know that the formula for cost of sales is just going to be opening inventory plus purchases minus purchase returns plus carriage inwards minus closing inventory. So we can start with the opening inventory, which is given right here. That's 54,000. We are given the purchases right here. That's 460,000. We're not given any purchases returns, and we're not given any sort of carriage inwards as well. So we only have our closing inventory of 57,000. So that's minus 57,000. And this results in our cost of sales to have the value of 457,000. Let's write it down. Now the difference between these two amounts is just going to be our gross profit. So that's 869,000 minus 457,000, which results in 412,000. That's the gross profit. Now we have already calculated the total for our administrative expenses and distribution costs. So we can just subtract those. We have administrative and then distribution. So the administrative expenses was 191,000 and the distribution is 161,000. Now if you subtract these two overheads from our gross profit, we'll be getting our profit from operations. And that's going to be 412,000 minus 191,000 minus 161,000, which results in 60,000. Then the final thing that we need to adjust for is going to be our finance cost. And we have already decided that we should be including the interest on debenture for the entire year rather than the amount that we have only paid for. So we need to include 8,000. And after adjusting for our finance cost, we can get our profit for the year. And that is just going to be 60,000 minus 8,000, which results in 52,000. Alright, that's all for this first part. We can now move to the second one now. Okay, we were given the working section right here. So you guys should be showing your workings for administrative expenses as well as distribution costs in this particular box so that you get your markings correctly. Now, we're given additional information. The directors found that the following transaction had not been recorded in the books of accounts. On 30 September 2022, the directors had made a bonus issue of 2 ordinary shares for every 3 shares held, and the directors had decided to maintain reserves in their most flexible form. We now need to calculate the balance of retained earnings at 30 September 2022 following the bonus issue. Okay, let's first calculate our bonus issue. So we were told that for every 3 ordinary shares that we have, we'll be providing 2 bonus shares. Let's first figure out the total number of ordinary shares that we have. Okay, we're given the total value and the nominal rate right here. And we know that in order to figure out the number of ordinary shares, we just need to divide the total value by the nominal rate. So that's 420,000 divided by 0.50, which results in the number of shares to be 840,000. Okay. Now for 1 ordinary share, there will be 2 by 3 bonus shares, but we have a total of 840,000 ordinary shares. Now we will get 2 by 3 times 840,000 bonus shares, which results in a total of 560,000 bonus shares. And we know that the bonus shares can only be issued at the nominal rate, and our nominal rate for this question is 0.50. So the value of bonus issue is just going to be the number of shares, that's 560,000, multiplied by the nominal rate of 0.50, which results in the value of 280,000. That's the bonus issue. Now remember that bonus issue will be funded by our reserves. So let's have a look at our reserves now. And we are also told that the directors would like to maintain the reserves in the most flexible form, which just means that we first need to fund our bonus issue by share premium. If it's not enough, we move towards general reserve. And if it's not enough, we then move towards our retained earnings. This is our Q. So let's first look at our share premium. Share premium has a total of 210,000. Okay, so we can utilize 210,000 to fund 280,000. Still, we will have 70,000 remaining. Now we'll move towards the general reserve. So let's have a look at general reserve. We're actually not given any general reserve. So there's no general reserve, which means that we now need to look at our retained earnings. This just means that the remaining 70,000 for bonus issue will be funded by retained earnings. Okay, now we can move towards calculating the balance of retained earnings. So we're just going to prepare the retained earnings column from our statement of changes in equity. We'll start with our opening balance, which was given above. The opening balance of retained earnings right here, that's 125,000. And we've already figured out the profit for the year, which should be added to the retained earnings. We figured it out to be 52,000. Then we have also established that 70,000 for bonus issue will be funded by our retained earnings. So we just need to subtract 70,000 from retained earnings, and this will be for our bonus issue. The only other items that will be included in our retained earnings is just going to be the transfer to general reserve, but we know that there is no general reserve in this question, so that's not really possible. And the next item will be our dividends paid. So let's look for dividends paid. We've already did this. We're given dividends paid right here, so that's 21,000, and we are basically paying out 21,000 from our retained earnings, so that should be reduced. So that's minus dividends paid. Okay, that's all that we need to record in our retained earnings section. So we can just move towards figuring out the closing balance. And this will be at the date of 30 September 2022. That's 125,000 plus 52,000 minus 70,000 minus 21,000, which results in 86,000. That's all for the second part. Let's move towards the third one now. We need to state one reason why the directors of a company might decide to make a bonus issue. So bonus issue is basically the company repaying back the shareholders so that they are satisfied with their investment. So we can just say that it is to reward or satisfy the shareholders. That's all for the third part. Now for the fourth one, we need to explain one reason why trade payables and potential lenders might approve of a company making a bonus issue. So remember that the company can pay back to the shareholders in two different ways. One is going to be dividend, and this is going to be cash dividend, which means that the company will deposit a certain amount into the shareholders' bank accounts. So the company will have to have enough cash holdings in order to pay those dividends, and the next form that they can pay is just going to be a bonus issue. And in bonus issue, the cash will not go out of the company. Instead, the company will utilize its reserve in order to increase their ordinary shares without having to pay the shareholders. It will just increase the shareholders' value of shares as well as the number of shares. Now, this might be beneficial to trade payables and potential lenders, because remember that dividend requires cash payments, which means that it might decrease the liquidity position of the company, but bonus issue does not require any sort of cash payments, which means that the company will be highly liquid if we make a bonus issue. Now, trade payables are those parties that we still have to pay. So if the company have enough cash holdings, then the trade payables might get their money back earlier. So that's one benefit. And for potential lenders as well, they will try and get the money back from the company as soon as possible if the company is in liquid position. So the reason is basically that the bonus issue is a non-cash item, so the company will still have its liquidity intact. Therefore, there will be no effect on repayment of liabilities. Let's write it down. A bonus issue is a non-cash item, which means that the company's liquidity position will be intact. Therefore, it will have no effect on the repayment of liabilities. That's all for the fourth part. Let's move towards the fifth one. We need to identify 3 points the directors should consider when deciding whether to pay a dividend. So the first thing that the directors need to consider is the amount of profits or retained earnings available for distribution. So the amount of profit or retained earnings available for distribution. And this is because the company will only pay dividend if the company has made some profit. If there is loss, then they will be in no position to pay a dividend. The next thing is the liquid funds. So availability of liquid funds to pay dividends. This should also be considered. And the third thing that we need to consider is shareholders' expectations. How much is the shareholder expecting to gain from dividend this year? That's also a factor that should be considered. So shareholders' expectation. Alright, this is all for the fifth part. Let's move towards the sixth one. Now we're given additional information. The directors of J Limited wish to improve the company's liquidity and they will choose one of the following options. For option 1, we are allowing trade receivables a cash discount of 5% for payment within 20 days. And for option 2, we make all purchases on credit from a different supplier who is prepared to offer a trade discount. Now for the sixth part, we need to advise the directors which option they should choose. We also need to justify our choice by discussing both options. So let's start with option 1. In option 1, we're allowing trade receivables a cash discount of 5% for payment within 20 days. So we're basically encouraging earlier payment by credit customers, and this might improve our cash holdings in the company. So we can write it down as will encourage earlier payment by credit customers which will improve liquidity. Secondly, we're also allowing a cash discount of 5%, which means that even if we received the amounts earlier, the amount received from credit customers will be less than what we should have actually received for. So amounts received from credit customers will be less. And then the next one is that since we are allowing a cash discount of 5% for payment within 20 days, many of the credit customers will be encouraged to pay early, which means that it will reduce our risk of irrecoverable debts. So reduces the risk of irrecoverable debts. That's all for option 1. Let's move towards option 2. For option 2, we are making all purchases on credit from a different supplier who is prepared to offer a trade discount. Alright, so the first thing is that we are switching the supplier now. So we do not know whether or not the supplier will be reliable. So we can question that. Will the supplier be reliable? And if we do not know this new supplier, then we cannot really know whether or not the quality will be maintained. So will the quality be maintained by the new supplier? But we are told that the new supplier is prepared to offer a trade discount, and if we are offered a trade discount, it means that our income will increase and the profit will increase as well. So might result in an increase in profit due to trade discount. Now, based on these factors, we need to advise the directors which option they should choose. Personally, I would go with option 1 because we are encouraging our credit customers to pay back early, which means that we will have reduced risk of irrecoverable debts. And if we're providing discount, it might result in an increased sales, which could improve cash flow as well. So I'm just going to write down my decision. The directors should choose option 1 as it might result in increased sales, which will improve the cash flow of the company. Okay, that's all for the 6th part as well as this entire question. So if you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.